Hi, this is Mike Burnick from Money and Markets TV. Over the past decade or so, investors have had an on-again, off-again love affair with emerging markets. Between 2004 and 2008, emerging market stocks soared 189% as measured by the MSCI Emerging Market Index. Now that performance far outpaced most other asset classes around the world, and it beat the Dow Jones Industrial Average by nearly a 5-to-1 margin. In 2008, the financial crisis pushed emerging markets sharply lower, along with pretty much the rest of the world. But they snapped back very quickly in 2009, rising 68%. That was more than double the return for U.S. stocks. However, emerging markets began to lose their swagger a bit in 2010, and that weakness has continued. Over the past 12 months, emerging market stocks rose just 2.6% versus a 26.6% gain for the Dow. But now this trend is beginning to shift once again. So far this year, for example, emerging market stocks are up 9%, pretty much neck and neck with the return for U.S. stocks. Now, this reversal of fortune makes sense from a risk-reward point of view, in my view. In times of turmoil, after all, investors move their money out of assets perceived as risky, such as emerging market stocks or commodities, for example, and they move those assets into safe havens like the U.S. dollar and treasuries. But now investors seem to be getting a bit more comfortable with taking more risk again, so assets are flowing back into the higher yielding assets. In fact, emerging market stocks have seen net capital inflows turning positive in June of this year for the first time in many months. And according to Bloomberg, emerging market bond funds have already taken in more than $46 billion so far this year, surpassing the total for all of 2011. In a nutshell then, investors are doing just what they always do. They're putting their money to work where it's going to be treated best. From that standpoint, emerging markets look very attractive. The International Monetary Fund expects emerging economies to grow 5.6% this year, accelerating to nearly 6% growth in 2013. By contrast, GDP in developed markets like the United States, Europe, and Japan are likely to expand just 1.4% this year and 1.9% in 2013. In addition to those GDP numbers, emerging market stocks are also a relative bargain right now compared to many other markets around the world. The Bloomberg European 500 index, for example, is trading at a price-earnings ratio of about 16.6 right now. And with profits expected to fall further, with Europe now in recession, that PE ratio is only likely to go up. Meanwhile, S&P 500 stocks are valued at a more attractive PE of 14.3, but concerns here at home about profit growth are also on the rise. By comparison, the MSCI Emerging Market Index looks dirt cheap today with a PE ratio of just 11.8. That's well below its long-run average of 16 times earnings and also a lot lower than Europe, Japan, or the US. Bottom line, money is being treated to better long-term profit opportunities in emerging markets. So it's really no surprise investors are responding. I believe this may only be the start of another phase of a long-term outperforming uptrend for emerging market stocks. I'm Mike Burnick for Money and Markets TV. Thanks for watching and good investing.